Okay, my beautiful friends, here we are, you and me together again at last. It's been a long weekend. I miss all of you. I really mean that. When I don't do these videos, let's say because of a 3-day weekend or whatever it might be, I kind of feel weird. Anyway, I enjoy being here, and I am glad you are here as well. So let's do this. This is my newest segment of Markets A Look Ahead. I want to talk about a bunch of things with you here, what's going on, what we have to look forward to, what OPEC just decided to do. Won't be a surprise to any of you who follow this blog here. And something very sad. Let's start off with this here. So the credit tracking agencies are now saying, this is a phenomenon I believe you and I realize would happen, and we've seen this as of late. More people are taking out loans, borrowing from their credit cards, just to buy groceries. People can't make ends meet. I mean, this is a phenomenon that's been going on for quite a while. It's getting progressively worse here. But you know how great everything is. Ask a single Fed president, ask the Fed chairperson, ask our president. He'll tell you there's no inflation, and American citizens, our economy is booming. Well, I mean, the proof is in our face, and I think we are all well aware of that. But this is a terrible piece of news. And this is a phenomenon that's going to get worse moving forward as people struggle, try to make ends meet. This is mostly previous members of the middle class here who are trying to keep that status, clawing themselves higher by getting themselves deeper in debt here. How long ago did you and I speak about this? We knew this was going to happen. We covered it right here in this video blog. I hope this is not you. Unfortunately, it probably is some of you out here. We are literally in the middle. No, not even in the middle. In the very, very early stages of a full-on global economic meltdown. And this is being driven by one force. Central banks around the world who run the entire financial system. They run the whole economic system. It's not our policymakers. It's the central banks. And no one's, again, still being held to account here. And no one will. And that is a terrible thing. Anyway, so here's the situation with this market as of late. And I think it's pretty evident as well. We have a lot of volatility in the stock market, but why? What's the driver here? We've seen an extreme amount of volatility in the debt market. People, look, I covered this recently. Bond yields, more specifically the 10-year yield, which is the benchmark, is not supposed to be going up and down like a yo-yo like it is as of late. And as that 10-year yield is going up and down like a yo-yo, clearly this is a sign of instability in the debt market. It's pulling the stock market up and down too. And there's also another player here, and you know what I'm about to tell you, I think. It's crude oil. Crude oil, people, how do I say this another way to you? It is the lifeblood of the market. It is the lifeblood of the military-industrial complex. Investment banks leveraged beyond their eyeballs in crude oil, energy. The whole energy sector obviously is dependent on crude. Okay, so we've seen crude oil fall lately. We've seen around $90, $91 a barrel. I'm talking about West Texas Intermediate, which is the one most people watch who follow the market. Now, being that you and I realize crude oil is the lifeblood of the market, supports the financial sector and the energy sector, wouldn't you know it, OPEC just said, hey, you know what we're going to do? We're going to cut production. Of course they are. Again, the market's dependent on it. Okay, so they cut production, crude oil goes up higher, gives the financial sector a boost, gives the energy sector a boost. It's just a game. All of this is a game that they play. And the game is being played. And who's losing? The people of the world are losing here. But still, no outcry. All you are seeing is more distractions, more look here, don't look here, propaganda, misinformation, fake news, data, which none of it at all has even the slightest bit of reality connected to it at all. Honestly, it's out of control. So just to put another perspective on this, people, and I want you to understand why this is so important. You know what I have said many, many times. If you were to turn on any of the mainstream propaganda ministries, I'm talking about Bloomberg, Fox Business, CNBC, what do? They constantly pull your attention over to the stock market, the stock market, the stock market. When you have any entity like that trying to force you to look in one direction, you got to say what's really going on. They're not discussing, not one that I have seen, and I follow all of the mainstream outlets. They're not talking about the market driver, which is the debt market. They're not talking about instability in the debt market. They're not talking about these gyrations that we're seeing in the 10-year yield. They're not talking about global bond yields rising. Why? Because you're not supposed to know that's going on here. You're not supposed to know that these are clear signs of instability in the debt market. And if the debt market lets go, people, look, it's going to let go. You know this if you've been following this blog. It's deliberate. Central banks around the world have chosen to do one thing, and that is basically take over the debt market to drive the price action of every single asset. Look, you, me, the Federal Reserve, and anybody with one fraction of a functioning brain cell realizes that every asset class, whatever it might be, derives value from what's happening in the debt market. For example, mortgages, bond yields, all based off of what the 10-year yield is doing here. Interest rates is what I meant to say, off of what the 10-year yield is doing. Okay? So why do you think central banks have gotten in here and suppressed rates for all this time so they can push cash into assets which shouldn't be going into, creating massive distortions across the spectrum? Look, there's not a single asset class today that has a real price discovery mechanism behind it because the debt market is fake. All the action here of central banks, and they're continuing to inflate. Central banks are continuing to inflate. They're continuing to buy the debt. Look, don't take my word for it. The ECB has come out and admitted it. The European Central Bank said they're buying all the debt across the entire Eurozone, okay? The Federal Reserve has not admitted it, but they're clearly doing it. How does a central bank keep rates low? How do they do it? Are they magical? No, they're not. I've said this a million times. They don't have magical power. They don't have godlike power. They can't just say, this is what we're going to do. Though we're going to keep rates low. We're going to do this. We're going to do that. No, they have to get into the market. They have to create cash out of thin air, get into the market and buy the debt. But you see, people don't know these things. They just think the Fed can just say, hey, you know what? We're going to keep interest rates low. You can't just say it. They have to get into the market and make it happen. And I'll tell you something else that's going on here. So, as you well know, we are in the extremely early stages, my view, of a full-on liquidity crisis. What does that mean? The system is going to lock up. Central banks are trying desperately to keep the system liquid. One of the schemes that is going on is the Federal Reserve reverse repo program, where trillions of dollars is being moved around overnight between institutions. This mechanism is in place for one reason: to fake liquidity, to trick the market into thinking it's more liquid. Okay? Liquidity is drying up. You got the debt market selling off, bond yields rising. Okay. You got stocks selling off. Okay. So where's this cash going? Remember, it doesn't grow money wings. What's happening here is you're getting this knee-jerk reaction: sell off in the debt market, sell off in the stock market, and people are hoarding dollars. Look at the relative strength of the dollar. Okay, it continues to go higher. No surprise to you. We discussed again right here, I don't know how long ago, a year? Longer than a year ago, that you and I would witness the Dixie, or the relative strength of the dollar, continue to go higher. And I'm going to tell you something else. You want to know a big secret? I don't think it's done. I think the relative strength of the dollar can potentially go much higher than it is now. And that's obviously not good for multinational corporations, but it doesn't matter anymore. Earnings, forward guidance, PE ratios, none of this stuff matters anymore when you have central banks continuing to rig the market to the highest possible order. So understand what you're looking at here. This instability in the debt market is not done. The gyrations here in the 10-year yield is not normal. Okay, the debt market is supposed to be stable, and assets are supposed to derive value from what's happening in a stable debt market. We do not have that. You understand? Okay. So, is this going to get out of hand? I don't know. Okay, we're entering a kind of a danger zone in the market right now. Okay, this time period, market can be extremely volatile, but forget about the stock market. Like I've been telling you since time immemorial, people. Focus on the debt market, focus on the drivers. I gave you two things to look at. One, the 10-year yield. If you don't understand the 10-year yield, that's fine. I set this up in a neat little equation called the MMRI, Mannarino Market Risk Indicator. There is a link to it right in the description of this video. I don't charge a dime for this. It's free to anyone who wants to look at it. Just click on that link, takes you right to my website. Scroll down, it's right there. The Mannarino Market Risk Indicator, people, is the best risk indicator based on what's happening in the credit market that's ever been created. I'm telling you right now. Okay, I know I created. I'm really not tooting my own horn, but there's nothing better. It takes the relative strength of the dollar. It uses the 10-year yield, makes a little equation out of it, and comes up with a number. And that number is color coded. It could not be more simple to just follow the MMRI, and you can see where we're going. A rising MMRI is obviously not good for the market. Okay, in this environment, we want to start to see that come down. We want to see bond yields start to normalize. Now look, 10-year yield could normalize at whatever it might be, 3.25, even 3.29, 3.4. If it's stable, if that number remains stable there, the market is going to be okay with it. But these gyrations in the market are not normal. And that is what's getting the stock market rattled. Market participants, you, me included, realize that this instability in the debt market could get grossly out of hand. A massive sell-off in the debt market would wipe out the stock market. And I'm talking about wipe out beyond people's wildest dreams. I mean, you know how this is going to play out. A massive sell-off in that debt market, rate spike, crushes the stock market, and cash doesn't grow money wings. It's going to go into commodities, people. That's my take. That's where I believe it's going to go. I also believe it's going to go into cryptocurrencies. I really do. Bitcoin now is hovering under 20,000. Does it have room to drop? It may. I told you my take on this a long time ago. I wanted to see Bitcoin hold above 21,000 for a sustained period of time. We were unable to do that. So I have yet to buy it again. All right. And I promise to keep all of you on top of this. You're going to know exactly what I'm doing. I will tell you here in this video blog. I will tell you in my free newsletter. Again, link in the description of this video. People, I got your back. I got your back. We're a team. We're a family. Okay. This is a global family. What do I got? About 225,000 subs right now. That's a big family. And we got to look out for each other as always. All right, people, look, I was just writing stuff down here this morning. I think I covered everything I wanted to cover with you. So please let me know what you think about this video. Comment here. And I'll see you in the morning. Have a great rest of your day. And that's it.